Hi everyone, so today we're going to be looking at impairment of assets under IAS 36. So an impairment is recognised when an asset is overstated in value. Okay, where the book value is, where the actual value of the asset is below its carrying amount. Okay, so let's look at some examples of assets. So intangible assets like brands fall under IAS 36. So if, as an auditor, if you spot that there's some negative publicity associated with an intangible asset, that might be an indication of impairment because people are less willing to buy products associated with that given brand, for example. Property valuations, okay, that's an example. Properties are an example of an asset. Another example of an asset, ships. Often impairments associated with ships are apparently quite a common occurrence according to my colleagues who work in audit. Especially I imagine with COVID. With COVID there's an increased focus on evaluating whether there are any indications of impairment with assets. Okay, let's look at when do we actually record an impairment though? When do we actually record an impairment? Well, it's when the recoverable amount of an asset is less than the carrying amount. What does that mean? What does recoverable mean? Well, recoverable means is about the maximum amount of monies that we can recover from an asset. We either get economic benefit from an asset either by using the asset as part of the business or by selling it. Okay, so it's the maximum amount of money that we can get from the asset. And how do we calculate that? Well, it's the higher of the value in use of the asset, so the value we get from using the asset, and the fair value less cost to sell, which is associated with selling the asset. So value from use asset we can calculate using a cash flow forecast. Cash flow forecast would probably be associated with multiple assumptions like the time value of money, the associated cost of using the money, what items are actually cash flows, which ones aren't. So there's a bit of subjectivity. You know, you have to, if you're an auditor, assess whether the cash flow forecasts are reasonable. Have they over projected revenue and under projected expenses, etc. For fair value less cost to sell, you generally would need an independent valuer. An independent valuation would be better evidence than one done by the company itself. And arranging a fair value assessment might take a bit of time to do and can be maybe costly because you're paying somebody else to do it. Okay, I'm just giving some real world information, but FER will just be about remembering these rules. So what happens if we do spot an impairment? Well, the impairment is going to be calculated by the carrying amount less the recoverable amount. Okay, how much does the carrying amount exceed the recoverable amount? The double entries we put through generally are debit, expense, credit, asset, so fairly simple. IAS 36 only applies to a certain number of assets. I've included the main ones here. So it applies to PPE, which you'll come across a lot in FAR, intangible assets, goodwill, investments in subsidiaries, associates, and JVs. Okay, but doesn't apply to inventories, because we recognize inventories at lower of cost and net realizable value. Financial assets, well, there's now a long-winded expected credit loss model that we use. And held for sale assets, which I've discussed before, where we just use the lower of carrying amount and fair value less cost to sell. Now, the treatment for impairment is different for different groups of assets. So in one group you have intangible assets where the useful life is finite, and PPE. So these two groups of assets are depreciated. Okay, so we're already recognizing an expense. In this case, we just assess for indications of impairment. Okay, so consider, is there any negative publicity associated with the intangible asset? Does it look like the PPE is damaged at all and not working as efficiently as it used to? Okay, only if we find there's an indication of impairment, then we estimate the recoverable amount of the asset and then calculate the impairment expense where necessary. Now the difference is that for goodwill and intangible assets where useful life is indefinite, we don't have an amortization charge going through the P&L. So what we instead do is we do an annual impairment test. And the annual impairment test involves estimating the recoverable amount. So again, for estimating the recoverable amount, you can use the fair value method, calculate the fair value of the asset, which is difficult to do, or you can use the value and use model, where you use cash flow forecast to calculate it. And I've audited a value and use model before, but I haven't audited an fair value model. Okay, so you estimate the recoverable amount and then compare it to the carrying amount and see if there's any indications of impairment. Okay, and if you're an auditor, this will take a bit of time to audit. Okay, and you have to get your head around the different assumptions used in the calculation of the recoverable amount and assess whether they're reasonable. Okay, and then that's it really. Basically, impairment is when the carrying amount is higher than the recoverable amount. It's just simple as that really. But it's an important area for audit, especially with COVID-19, which has led to COVID-19 being present, which has led to assets reducing in value. Okay, hope that was useful, and thanks for listening. Cheers, bye.